want to say thank you to everybody joining. My name is Paul Hitchcock, and this is a brand new episode of Wealth Protector TV, which is our channel connected to the law firm Barth Calderon. If you don't know us, we're an asset protection, estate planning, business planning firm. And Katie, really excited to have her on board today, is one of our top attorneys, expert in estate planning, trust settlement, probate. And I want to share my screen. I put it in the chat feature. We do a lot of this education, and our goal is always to provide high value content that can help you in some way. Obviously, as we do these, we can't get into all of the nuance of every single issue that might come up. And today's a hot topic. We've got a lot of people that signed up for this. And so we offer, I'm going to share my screen here. I put it in chat. You can see this. If you have questions, Katie, can you see this up there?
Yes.
Okay, for anybody that wants to get one-on-one with Katie for questions on your own planning, or maybe you're an advisor working with others and counseling them and issues about planning come up, maybe you're in real estate or wealth management, whatever the case is, if you text Guard Assets to that phone number, you will get an opportunity to get with Katie one-on-one for a free strategy session. And I take the first initial call to understand what's going on and get you connected. So make a note of that, take a picture of that, write it down. It's also in the chat. And Guard Assets. Okay, so I'll show that maybe one more time before we end. So Katie, welcome. And yeah, this is going to be great. As I look down here, I've got some bullet points. I know that you and I were talking ahead of time to go over, but I want you to jump in. And we're talking about trust administration, probate. And one of the first issues that you have written down here is how a trust differs from a will. You can start anywhere you want.
Yeah, sure. So kind of to start, there's always some stuff you have to do when someone passes legally. You know, if they have bank accounts, they own property, if they have any assets, there's some work to get those assets from them to their loved ones. The question is, what process do we need to use to get it there? So most people are familiar with a will. A will is a document where you write out, here's what I want to happen to my stuff when I die. What a lot of people don't realize is that a will is administered by the probate court. So yes, a will help your stuff get to where it needs to go when you pass, but that's done through a court process. And in California, that court process is very long, very, very slow, especially right now, extra slow, and expensive. There are statutory attorney's fees, statutory executor fees. So you pay based on the percentage of the estate, and you don't deduct out debt, you don't deduct out mortgage.
If your house is worth, market value $2 million, let's say you got $1 million debt on it, is it true that it's $2 million that goes into the value?
Yes.
Insane. Yeah. Okay.
Yeah, so in California, you can see why probates quickly become very expensive. Right. And the courts are just backlogged, they're slow, it's a process that nobody enjoys, and you really don't want to end up there. So if a will is administered by a probate court, what other alternative do we have? And that's a trust. You kind of think of a trust like a separate entity. So instead of you owning stuff as an individual, your trust owns your assets, or you own it as trustee of your trust, which sounds a little bit scary because you want to keep your stuff and you don't want to give it away to an entity, but it operates very simply. You don't have to file separate tax returns. You can still buy and sell things as you wish. You can still manage everything because you're the trustee or the manager of the trust. It operates very simply, and kind of once you get going, it's a very easy kind of thing to use.
I've heard it described sometimes, tell me if this is accurate, as, if you want to control your life story and you don't want somebody else to do it, the courts, think of it as actors on a stage. Your assets, the people you love are on a stage. You're the director of that play. You control how it goes. That's a living trust. Is that a fair analogy?
Yeah, because when we set them up, you're the settlor who's the creator and owner of the trust. You're also most often the trustee of the trust. So you're also the manager of the trust. So between being the owner and the manager, you pretty much have all the powers to do anything that you'd want to do. But what's great about a trust is it not only plans for what happens if you should pass, where your stuff will go, but it can plan for your incapacity also. So you can name what's called a successor trustee. So you can list who will manage the trust in the event that you cannot. But I think one of the big things that you have to watch with the trust is your will just would govern whatever you have. You say, I want to give whatever I have to these people. Your trust, we always say, it works like a delivery truck. Whatever you load on it, it takes with it. So kind of as a segue into some of our topics today, one of the big things we see with trusts is you have to make sure they're what we call funded properly. When we talk about that delivery truck, was everything loaded on, because the trust only governs the things that you add into it.
Now, did you try to one up me with your analogy of the delivery truck because I had the stage? Was that, a little competitive thing?
Definitely. I think we all have our own analogies, because when you're going through these topics, I think it's helpful to kind of have your to be able to envision kind of what we're
talking. Absolutely. Yeah. Okay. So you're jumping into, what are we going into now is what the trust does. So what's the next step?
Yeah. So how does a trust work? So I think we're eventually going to get to some pitfalls, but I think having a basic understanding of how a trust works is really important, because we run into a lot of clients who say, oh, I have a trust, I'm good. Right. But do you know what your trust says? Has it been a while? Because sometimes people think their trust says one thing and they're a little bit surprised if they haven't reviewed it in a while. And
What's a while? What's a while in your mind?
Ideally, you'd have someone take a look at it every 5 years, maybe even 3, but for sure any major life events, births, deaths, you have some grandchildren now, maybe your husband's passed, anything like that, you would want to get it reviewed.
What about changes in laws?
And that's another thing. There has been some big changes in how we structure the trust in the last about 10 years. So if your trust is more than 10 years old and you're a married couple, it most likely has some burdensome administrative things that you're supposed to do when the first spouse passes that most likely you would not choose to keep in there. So, I mean, there might be some reasons we would still do it, but I would say 90% of clients want out of that kind of structure that's obsolete once they kind of understand what they have and understand what they could now have. They're interested in updating it. So I would say if your trust is over 10 years old, it's really important to have it reviewed. Okay.
Because there are things now that matter. I mean, the medical directives and financial powers of attorneys, is that considered part of a trust or part of the estate plan scenario?
Yeah, good question. So we talk about trust because I think that's kind of what we see as the main kind of anchor document. But when we meet with clients, we typically do what we call an estate plan. So your trust is, we draft a trust, but then we also draft a durable power of attorney, a medical directive, HIPAA waivers. We make sure, and what we call a pour over will, which is a just in case will, you forget to add something onto that delivery truck. And also your will is where you name guardians if you have minor children. But we basically draft everything that you would need in the event of either incapacity or death. So we're not just concerned with what happens when you die, what happens to your stuff, but more importantly, I think for a lot of us, is what happens if we live and we don't have capacity? Is there someone who has the authority to make our medical decisions, our financial decisions? Is our stuff going to be easily taken care of by those people, or are they going to have to go to court during your lifetime, which is called a conservatorship, to access your accounts and to make your decisions for you?
So I think a lot when you're talking, not only for like the person thinking of themselves, but a lot of people are helping their elderly parents with their planning. So do you get into that at all, where it's really important to make sure your parents have all this stuff in order?
Yeah, because I think ultimately it is the kids who are the ones that have to deal with this,
Right.
right? So how can we make sure that our parents are in a good place where everything is kind of lined up? And some of it, it depends on them, because ultimately their willingness to include their children in this process is totally their decision. Some people are very private, they don't like to, but ideally, they've kind of pinpointed, who is the person that's going to be making these decisions for them if they're unable to, and they loop them in a little bit. We recommend, if someone's aging, we said have your estate plan reviewed, make sure who you're choosing to be your power of attorney, who you're choosing to be your successor trustee, the people that you're naming to take care of you and all of these documents, that they've been updated, that it's not a predeceased spouse or anyone else that would be inappropriate.
Does it have to be the same person for all those roles?
It definitely doesn't. It often is helpful to have them be the same people, because if you have one person making the medical decisions, I'm going to put mom in this nursing home, and you have another person holding the purse strings, if they disagree, it can get a little complicated. But those are the things that we talk about when we sit down with a client and they're choosing different people. Sometimes there's a good reason to choose someone different to make your medical decisions because they're better suited for that role. But sometimes if there's going to be conflict with someone else, maybe not the best decision.
Right.
It really depends on the personalities that you're picking.
What about if your parents have a cognitive disorder and they don't have their planning in place? What happens then? If you're kind of late to the show.
Yeah, I'd say worst case scenario, then if you need to access their accounts and you need to make some type of decision and you need to be able to show authority for them, especially if there's a dispute, if there's ever two people who want to make those decisions or two people that want to access, you have to go to the probate court for something called a conservatorship. So it's basically like a probate during lifetime. You have to go ask the court for authority to access the accounts, authority to make financial decisions, and authority to make medical decisions. It's a huge pain. But that being said, still talk to an attorney, because sometimes there's things we can do, particularly if they have powers of attorney. Sometimes if they have an old power of attorney, we're able to fund assets into a trust and kind of save the situation with some older documents. And they may not be ideal, but maybe they're enough to get us to a point where we can do some planning for them.
So is the language that goes into a power of attorney always different for every power of attorney? Is it tailored language describing what can be done in there?
Yeah, I mean, I think we all have our favorites that we include, but depending when we talk to the client, how much power they want to give and how much trust they have for these people that they're naming, we can give a lot of power or we can limit it. So one of my favorite powers and what we often give is the ability to fund trusts. So that way, if you get to a point where you've lost capacity and maybe we need to add something to your trust or create a new trust for some reason, that someone might have the power to do that for Medi-Cal planning or for any kind of advanced planning purposes.
Where do you see, what is your recommendation as an expert, Katie, when you're talking to families, about the family dynamic situation and parents talking to kids, when to include them? You have some advice there.
Yeah, I mean, I think there is a time for a lot of people where you realize that you might not be completely capable of managing all your finances on your own. And I think that's kind of the end game. If you could talk to your kids earlier, if you feel comfortable including them. I mean, I always kind of give a spectrum. Either you're really comfortable talking to your kids, great. Sit down with them, explain your trust. It's great if they know what's going to happen, if they know who's going to step in. You've shared kind of where your assets are. If you're not comfortable with that, what I recommend is that you write it down and you include it with your estate planning documents. So say, you're talking to your parents or you're elderly and you're thinking about your kids, you're like, you know what, I'm really private. I don't want to share what my finances are. Some people say, I don't want them to get too antsy. I don't want them to think it's already theirs or something. Some people, whatever the personal reasons may be, say, you know what? Write it down. Make a list of your assets and where they are, and preferably how they're titled or who the beneficiaries are. So when a parent passes, if the child isn't aware kind of the parent's financial situation, they basically have to play detective, sometimes months, sometimes longer. Did mom and dad have a life insurance policy? Where? And then when you contact the life insurance policy and say, hey, I found a payment stub, does mom have an insurance policy? They won't talk to you. You send in death certificates, you send in things. And if you're the beneficiary, they'll generate paperwork to your house, but you don't know, was the trust the beneficiary? Am I the beneficiary? And we spend hours chasing down this information, where if mom and dad had left their policy and confirmation of beneficiary designations with their trust finder, that would have been a really easy project. So if you could list, I have Bank of America accounts in my trust, I have an IRA at Merrill Lynch, and these are the beneficiaries, and I have 3 life insurance policies, these are the beneficiaries. If you put that with your estate planning stuff, that makes your children's job much, much easier.
Yeah, and when it comes to a trust with assets like property, if there's multiple kids, and you're transferring property, other assets, how do you advise people on that? What if all the kids don't want to keep the property? Kids have their own kids in college, and some say, I want to sell the property, I have college expenses. Others say, it's a great rental property. I mean, how do you get around those issues? Can you design a trust a certain way? What goes in there?
Yeah, the best part about a trust is it is as customizable. There's pretty much no limit to what we can do. So in that instance, if the parents know going into advance, my son Sam lives in the house, maybe the trust, his share isn't going to be large enough for him to take the house alone, and you don't want to give it to him because then the other siblings wouldn't get an equal share based on your assets. Well, we could give Sam the right to purchase the house, maybe to credit his third to the purchase price and then bring in the rest. We could give him some kind of initial right, and then if he declines, it would be sold and the proceeds would be divided up. That's one thing I would suggest for someone who knows in advance they want to give a specific piece of property to a child. We can either write it in, or if there's not enough to kind of equalize, we can make it some type of purchase right. Once someone passes, if we're left in that situation, we basically pool all the assets. So we don't necessarily have to give, so say there's 3 kids, a third of each asset to each child. We would have the assets appraised, and if they can agree on a distribution, as long as it's equal, we pretty much let them figure that out. The trustee is the ultimate decision maker. So you'll want somebody who can broker that piece in that role. And if nobody can agree, ultimately we would sell everything and just distribute out cash, because if we can't get everybody on board, that's the most fair way to handle it.
Okay. Is an estate always audited when someone passes away? Is that just a given?
You mean, are there tax-wise?
No, I guess, like you said, I guess you said do evaluation of the estate. So do you always need to do that when someone passes? Does somebody come in to value all the assets, a CPA or somebody else? Is that pretty typical?
Yeah, so what we do is I handle what we call trust administrations. And I think you referred to it earlier as like the settlement of a trust. So we've kind of talked about what trusts do, but we haven't really talked about how you handle a trust when someone passes.
Let's do that.
So typically there's something to be done. If it's a really simple trust, and we kind of talked about, the older trusts with these more burdensome provisions and the newer trusts that are easier to administrate. If it's a married couple and the first spouse passes and it's a simple trust, there's very little to do. There's still some stuff to do, but it's mostly we have to lodge a will, notices to some government entities, kind of make sure everything's updated. It's pretty simple. But when the second spouse passes, or if you're single, if you pass, then we have your trustee has to come in and kind of administrate the trust. And what they need to do is take control of all the assets, make sure your final tax return is paid, make sure any fiduciary taxes are paid, value the assets, not so much for estate tax purposes, but to be able to divide things up first. So if someone wants a house, we know it's worth $1 million. Second, it's for what we call a step up in basis. So if you own a home when you pass that you purchased for $100,000 back in 1970, and it's now worth $1 million. If you were to sell that home while you're still living, you would pay capital gains on the difference, minus an exemption if you live in there. But basically, as a general principle, you would pay capital gains on that $900,000. If your child inherits it, they get a step up in the tax basis up to the value as of the date of death. So if the house is worth $1 million the day you pass, if they turn around and sell it, they pay nothing in capital gains. So we hire just, real estate appraisal to make sure and document what the value is as of the date of death. So if you go and sell it, 10 years down the line, your accountant has that appraisal so they know how to calculate your capital gains. Okay. But it's just one of the issues that we kind of flag out and help with as we're administering a trust. But your job is to take control of all the assets. If they have a bank account, make sure you have access, figure out what needs to be sold, figure out what you're holding, pay any debts of the person who passed, and then distribute out the assets according to the terms of the trust, which is often, equally amongst my children or whatever it may be. Sometimes it's also funding some sub-trusts. If you have children or grandchildren or anyone with special needs involved, the trust should protect them and not distribute money outright to people who, aren't in, a 9-year-old or someone who's on government benefits that are limited by income. So we would also be funding whatever trust the trust calls for to care for those people.
Okay, so special needs child, they would have a separate trust to take care of them, and so the money would be going into that.
Yeah, ideally, and that's one of the things you want to make sure your trusts are updated for. So when we talked about making sure it's updated, that your selections for selections for trustees are updated, but you also want to make sure that if you have any beneficiaries that are young or should not be inheriting money outright for any reason, special needs, or maybe spendthrift is what we call someone who's just not responsible, that money's not given to them outright.
Okay. Man, and where do you see things going awry in the trust settlement? What are some of the common mistakes and bad things you see?
The biggest one is funding. And remember, that's what we talked about, loading things onto the delivery truck or adding them to that trust. Yeah. So when we create an estate plan, we work with our clients to make sure everything is funded in, or they have clear instructions to fund everything in at the time that we create the estate plan. But not all trusts are created equal. Not all people do kind of the same level of analysis when they draft a trust. Sometimes people's trusts are so old that they've gone and acquired a bunch of assets and kind of forgotten about their trust, forgot about titling. So maybe they own real estate. Real estate's a big one in their individual names rather than in the name of the trust. Maybe they get a life insurance policy and they name their spouse as the beneficiary. Only the spouse, no secondary beneficiary, and their spouse predeceases them. When they pass, there's no one to pay that life insurance to, so it goes to the probate court, which it creates problems. So I say funding, making sure that your assets are in the trust appropriately is a huge one, and I'd say the other one is old, non-updated trusts.
Right. What about the chatter that I'm hearing others are asking about, where we've got a new administration in Washington and looking like there might be some changes that could impact estate planning? Any comment on that?
I wish I knew what they were going to be, because it would be nice if we all had a crystal ball and could plan in advance. I will say that we try to draft our trusts with a lot of flexibility. I know we have a couple just in case tax provisions that we standardly put in our trusts, which hopefully we won't need, but kind of just in case your estate grows. Because right now you can pass approximately $11 million per person tax-free when you pass, or combined with gifts at life. So either what you give in life and what you pass at death combined, you can give tax-free around $11 million. As a married couple, that's that's a little over 22 million. For most people, we don't have an estate tax problem right now.
Right.
I think we might in the future, and those current rules sunset in 2025. So unless Congress extends them, the estate tax kind of amount that we're allowed to pass will likely go down.
Yeah, because we've got somebody on the episode here asking, mentioning this. Biden is talking about doing away with the step-up basis between spouses. Question is, if husband died a year ago, but house was not sold, could the step-up basis be canceled if sold after January 1, 2021? Now, I'm just putting you on the spot there. I have no idea what the answer is there, but you can. Yeah, what do you think?
I think the question, well, first, just kind of a quick background for some people who maybe, it sounds like the person answering the question already kind of has a basic understanding of step up and basis. But in California, you get what we call a double step up and basis on community property. So if you own property as community property, even as part of your trust, you get a step up in basis when the first spouse passes and when the second spouse passes, okay, which is on the entire property, which is really nice perk, because if you own your house for 30 years and your husband passes and you want to downsize, which I think is a common scenario, or maybe move into assisted living or whatever it may be, you're not going to be hit with capital gains on all that difference.
Is that just California?
I'm not sure, because not every state has the same community property rules.
Got it.
I don't want to venture beyond. I know that's what we have. Community property in California has that special advantage because other types of property don't necessarily get the double step up. So the question is, might there be kind of retroactive changes? I mean, we hear I've kind of heard some really worst case scenarios where people are, there's going to be rules that are retroactive. I think practically I can't imagine if you have that step up in basis when the first spouse passes, that it's going to be erased sometime in the future.
Yeah.
I would say unlikely, but I don't know. I wish I had a crystal ball on the future tax issues. We do the best we can. And we follow what might happen, and we try to kind of hedge our bets the best we can, but.
Yeah, and I was going to say that I've heard you say before, and others at the firm, that you plan for what you know, which we know now, but there's enough flexibility built into the planning where it can mold with potential changes. Is that a fair way to say it?
Yeah, I think there's always the possibility that there'll be a big enough change where we would need to revisit things. I can say, to the extent we're talking about revocable living trusts, which was what a majority of Californians who do estate planning end up with, your trust is amendable and revocable as long as you're living and have the capacity to change it. So we do the best we can, and I think in most instances there aren't major tax changes that would mean we have to redo the whole thing, but if we need to, we can.
Yeah. And that's been that Prop 19 issue. I know we're not going to get into that here, but when you mentioned that double step up in basis in California, it's why, that's a big issue for Prop 19, because, accelerated transfer from parent to child has been brought up by the firm. But, if the one spouse died recently, maybe that could work. Anyways, it gets into Prop 19, and I know that's a complicated issue, but, we are handling those questions down the road too. For those. Yeah, what would your parting advice be, Katie, for people who in this area, your kind of your nugget, your takeaways, your nuggets?
Yeah, I mean, I think there's kind of, you're speaking one to the person who's actually aging and kind of getting older and concerned about these things, is communicate with your kids as to the extent you're comfortable with that. And if you're not comfortable with that, make sure that information is easily accessible. I think that's the best thing you can do to make things easier for your children. Have your estate plan reviewed by an attorney. Make sure it says what you think it does, and that it's the simplest administration for your kids possible if something were to happen to you. And then I think if you are a child kind of looking out for a parent, really watching and making sure, if they start to lose capacity, it's too late. So if you have the relationship that you're comfortable with speaking to them about these things, have these conversations, make sure you can help them. Some people like to bump up, maybe after, if someone loses their spouse and they're in their 80s, their 90s, if they're kind of aging and they were used to sharing the financial responsibility, or their spouse handled finances, we can bump up a child to help them as a co-trustee. There's things we can do to make things easier. So just, being informed to the extent your parents are comfortable with that.
Great advice. And I mean, you and I could go on for hours. There's so much more here. For those who may have not seen this in the front, if you have any questions at all about your planning, your parents' planning, wherever you are in the country, we have about 5,000 clients everywhere helping good families across the country. Text GUARD Assets to that phone number, and we'll get you one-on-one with Katie for a complimentary session. And Katie, I want to say thanks so much for coming on board. I'd like to have you back, but awesome information, really, really good stuff. So thank you.
Thanks for having me, Paul.
Okay, we'll see you next time.